Welcome back to the second episode of the We Hate Money podcast. I'm Arnie, and my co-host is Wiz. How you doing, mate?
Doing great, Arnie. Doing great. How are you?
Yeah, I'm going good. We've had a pretty interesting, busy week. You and I got off the ground last week, and now we're just continuing our upwards trajectory. And we've got a few interesting tidbits to discuss that we said we'd discuss last pod, but also just a few throwbacks to some of the things we mentioned. Just while we're on the topic of introductions, give us a like, comment, subscribe on any platform that you listen to us on. And yeah, happy to interact. We love questions and we love talking about anything and everything. So what's been going on, mate?
It's just been a good. I think it's been a good couple of information days last week, getting a good idea how the economy is going. Seems to be, I guess, still robust in many ways, which is always nice.
Absolutely. Yeah, you mean the US? You're talking about the US economy specifically?
Is there any other? No.
Well, my little Australian economy might have something to say about it, but it's no, obviously it's the one we're all focused on, the US economy.
Yeah,
But all at the same time, there's been massive news out of China over the last week, so we're going to talk about what's going on in the world's
yeah.
second largest economy as well.
I think we had a bit of a discussion on Discord not a lot, actually a while ago. I think at the beginning of the year about which way China could go. Just looking at the um, historic PPI numbers and things like that, as far as prices, and there's a possibility of a strong rebound, but that doesn't seem to be happening. If I'm right about what I'm remembering right now, I'm driving, so
Yeah, yeah.
anything I say may or may not be true.
Well, yeah, you're right. We did have this conversation and I think it was very topical at the time because, after China's economy or their government reopened after COVID zero, when they sort of abandoned COVID zero, a lot of people, you and I included, were sort of saying, maybe they're going to roar back to life the same way that Western economies did. And, they're going to spend all the money they've been saving over the lockdown. Everyone's going to go crazy. We're going to have like an oversupply of goods because China manufactures like something approximately like 1/3 of the world's goods, so they're going to be
Yeah,
back to the engine room, and in part, like some of that manufacturing side of the narrative has come back, but and China's growth estimates over the year, I think they were estimating 5.5% for 2023. Over the last quarter, they've done 5, GDP percent growth. So, or something like that. So I might have got those backwards, actually. I think they were forecasting 5 for the year. And I think over the first half of the year, they grew their GDP by 5.5%, which is actually modest for China.
yeah, that is, and you know, uh, we do have to be careful about the numbers for China as far as what they really are, because they do report things in a particular way. So we'll see at the end of the year, if they continue that rate of growth. Hopefully they do. Hopefully they nail it for the whole year and things are fine. Worst thing, we don't want you know any kind of slowing or deflation's not
Well,
necessarily a good thing.
they have slid into deflation over the last quarter. So the numbers that were reported was in their consumer price index, it fell by 0.3% compared to 2022, and the producer price index fell by 4.4%. So it's actually the first time that both those figures have been negative for China since November 2020, when everything sort of ground to a halt. So yeah, I don't know. It's an
Well,
interesting one, man.
it could be a canary in the coal mine situation, or it could just be isolated. But if it's happening in China, it's probably going to start to happen elsewhere. It's not a, they don't live in a bubble, neither does anyone else. Um, Maybe it'll be beneficial to other countries that are more reliant on China. I can't think of too many more than the United States. Um, But you know,
Yeah.
I guess it's good news as far as inflation goes. But until you get price decreases in the year over year numbers, those prices are still going to hurt people, unfortunately. So
Yeah, you're right.
we'll see.
I don't know. Like the thing is, and again, you and I have discussed this at length ages ago. I've spoke about it on the other podcast I'm on, where we were talking about China's three red line policy. And off the top of my head, I forget what those three red line policy, like what those major three things are that were implemented by the Chinese government. But it was basically put in place to curtail massive over leveraging in the real estate market, because the real estate accounts for about like 1/3 approximately of China's GDP. But for the past 2 years, since they had that three red line policy in place, it has just gone through a really bad patch where nobody wants to buy. All of the money that was already paid to those big developers was being demanded to be refunded, because projects hadn't yet started. So they were in huge liquidity troubles, these big ones. And Evergrande was the one that hit the headlines. But just recently, there's a very, very big developer in China called Country Garden, which is also
Yeah.
it's currently in a grace period for default on a US denominated bond. And apparently they've got a few local currency ones coming up. I forget how many. A mate of mine was saying I think there was like 10 payments they've got coming up, which they're also indicating they're going to struggle to pay. And these instruments were changing hands like 10 cents on the dollar or whatever the equivalent is in China. But yeah, man, it's like people have no confidence that this developer is going to be able to repay their debt. And interestingly, this one, Country Garden, was sort of seen as one of the more stable mobs over there.
Yeah, I think they were starting to have trouble last year, and it wasn't, people were pretty confident they would be okay. So to hear they're actually going into they're in a default grace period, I think it really just shows the magnitude of the problem has yet to really been measured. And these are all, to me, you know how I am on this. I think it's a bigger problem than currently we're willing to admit that it is. And it's just going to play out. It's probably why China started to ease at the end of last year. Um, I think their central bank kind of recognized that they're in a bit more trouble than they can pretend that they're not in. So I don't know. To me it's so it's a bit opaque, if that makes sense.
It's absolutely opaque. I mean, one of the big criticisms of China is that they use their local governments as like sort of like off balance sheet entities where they hide the debt. And so people have estimated that the debt burden for China's local governments is somewhere between 13 trillion and 23 trillion dollars, while their federal government's balance sheet looks pristine, because the federal government forces these local governments to take on debt. There's actually a fantastic YouTube channel that goes through this and explains it. And man, I forget the lady's name off the top of my head, but I will look that up during the week and I will drop it next pod because her videos on this are fantastic. But
see if you can put it in the description.
Yeah, good call. I'll do that. I'll put it in the description when I post this one. But yeah, but so just going back to what you were saying, this I sort of wonder. I wonder if the federal government is going to come through with a bit of stimulus rather than just easing of their policy.
I want to think that they did, but I'm sure they will do more. I think they did do. They've been telling banks to buy equities for some time. I don't know if that includes those companies or not. They have been doing some stimulus in that direction. I call it stimulus because whenever the government tells you to do something, that's what it is, especially when it comes to buying. But uh, one thing to note is that it's been a very um, long documented issue with China, with their local governments taking out more and more leverage in terms of loans on property. Because in China, I don't know if you know how the property laws work, but they're not like here in the West.
It's all leases, right? Like they can only lease it.
Yeah, you basically just lease the land from them, and you can or the house. I can't remember which one, but the China ultimately still owns that, so it's not private ownership in that way. And so their model for building is you put the cash up front, and then they go out and they're supposed to be building these homes. So it's definitely backwards from where we have loans that we're paying into, which creates revenue stream, right, for a lot of companies, and then they can sell securities based off that, which got us in a little bit of trouble. But in China, I mean, if they don't have the cash, there's people who've lost, I don't know how many hundreds of thousands, if not millions of dollars, if that money's just gone. So
I think so. Yeah. I don't know.
I mean, that to me is I guess it's better to know you lost your money up front than wondering if you lose it on the back end, right?
Spot
but
on,
at least
mate.
like in the US, you get the house and then you run out of money, where in China you just lost all your money. So I'm not sure
I mean, I don't
which one's
know.
better.
I definitely, definitely. I think, I think we've got more of a chance with the Western model. But what I will say is that, like, when it comes to shelter, it's a basic need. So, like, wherever you are in the world, you have to live somewhere.
There's
I don't
caves,
know.
Arnie. Come on. Yeah, no, you're right. It is a basic need. Well, what they were so they've been trying to refinance all their debt obligations for years for the local governments, because they were getting out of hand on shorter term debt. And I think that was at the end of the 2010s that was starting to really play out. So I'm not sure where that's ended up in the meantime, but it's a serious problem for them, because it's, I think, another way by doing the property leases that they're able to raise revenues. And as long as those leases continue to go up, they can raise more revenues. So there's a whole convoluted, I guess, kind of scheme that works if one hand keeps washing the other.
We should maybe get Mike Bob on if he's comfortable to have a little bit of a chat about this, because he would have intimate knowledge of some of this. But I reckon that's a good little overview of what's going on in China. Do you want to should we quickly talk about the US and what's been going on with their inflation figures?
Yeah, we should pivot back to inflation in the US, because just as interesting as China is, it is going to get a little off topic. Inflation, good in China. In the US is, well, it's not horrible, so that's good news.
Yeah, well, I think the rate of inflation, over the year to July, was 3.2% in the US, and that was like up from 3% in June, like the lowest rate in more than 2 years in the USA. Is that correct? So
that's right.
Yeah. So I don't know, man. It's like it's good signs. Like, obviously we're looking at like lagging data. I know that you and I in various Discord channels have been talking about it, and we keep getting pinged with certain information about like signs that maybe it's reinflating. So we'll sort of, as we sort of see over the next 3 to 6 months, see if these interest rates being held, or maybe one or two more hikes, is going to be able to combat that, or if we're going to see a spike or a wage price spiral, which I think we spoke about that last week, but I actually can't remember what we spoke about exactly. I know we mentioned it, but yeah. Well, I mean, the central bank, its interest rates at 5.25%. That's the highest level that the central bank, the US central bank, has had in 20 odd years, maybe a bit longer than that. I don't know. Their target, they still said it's 2%. when they say 2%, I think they're happy with between 2 and 3. It's a hell of a lot better than what it was when it hit its peak, which was in the 9%. So yeah, well, I don't know. How is it on the ground, Wiz? Are you finding that cost of living pressures are easing, or is it still really bad? And it's just the numbers are just, I don't know, not reflecting the substance of what's going on.
Well, where I live in the United States, inflation is always a bit higher than the rest of the country. We not much. It's so like when it was at the peak, it was almost 10% here. So the United States, so when the U.S. Bureau of Labor and Statistics put their CPI number together, it's an average. So there are parts of the country with higher and lower areas of inflation, and all of those metrics really kind of just get ironed out to a nice clean number. So depending on where people live, they face different battles. I find that from what I see people say on the internet and from work and people I know, they don't feel like it's improving. So they feel like it's sort of stagnated, like the price is still high. It's not necessarily going higher, but I'm noticing prices at the grocery store for some items continue to get priced up more and more.
What kind of items, Wiz? Like which ones? Off the top of
Well,
your head.
well, I noticed that, frozen pizzas, for example, they seem to still be going up in price marginally over the past couple of years. You may not notice it from month to month, but like 25 cents, 50 cents. There is a big price jump in terms of ounces. I know for bag chips, because I noticed they shrunk the size of the chip bags.
Wait, when you
So
say
they
chips,
decreased
do you mean like frozen chips, or are you talking about like crisps?
crisps. Yeah, what do you guys
Crisps.
call crisps?
Yeah,
Yeah,
right on.
sorry about.
I'm with you.
Yeah, and so I was like, because they I think they went from like a 16, 12 ounce on some bags or whatever, and the price of course remains elevated on those, and I think we're just going to continue to see pricing remain high, if not push higher, um, on certain items that are less liquid. Um, I just don't see I don't see the inflation resolving itself just yet. So it's part of the how inflation resolves itself. It sucks excess liquidity out of the money, and if everybody needs to buy food, right, where are people going to spend their money? Well, on food. So um, we're going to keep seeing that happen until that correction can be made, and hopefully the Fed can, help guide the country in the right direction for that. But 3.2% is encouraging. It's all encouraging news to see it closer to 2. And people should be encouraged that, prices are still high, but they're not astronomically higher.
That's right. That is right. And then
And
as time goes on, it has to ease. Like eventually it has to ease. So
well, how it breaks is what the damage can be. And it's not, to me, I think people calling for like a soft landing are being a little too optimistic. Not that you can do anything about it if it is a hard landing, right? Because you just end up in it anyways for most people. But to call it that, I think, insults the intelligence of a lot of people.
I mean, maybe
Because
it's such the terminology is so vague, like hard landing, soft
yeah,
landing, like so like what is soft for some might be rough as for others. So I guess it's just comparatively speaking, has the administration in the US done a good job of navigating this? I would actually say this
I
time, yes. I was very critical of them for not raising rates earlier. I think you were as well. But it
yeah.
seems to be that they're managing well from an outsider's perspective. I mean, you
Well,
you you might feel differently.
I think the Fed, when they finally decided that they needed to raise rates, responded appropriately. It was getting them to that point that was difficult. and I think frustrating for people who felt that they're not treating inflation seriously. And that was, during 2021.
When he was saying it was all transitory and whatnot. It's like, I think the issue was when they were saying it was transitory in 2021, we're coming off COVID, coming off lockdowns. We had all sorts of issues with supply chains, and that was obvious that supply chains were part of the issue. But really the only tool available at the time, which people know, was, the Fed's lever to raise interest rates and keep them elevated, because you need to address supply and demand was going crazy because of all the stimulus. So
Yeah,
I think what you were saying was is like that was the big issue. And then I honestly think that if the war in the Ukraine and Russia didn't happen, and there wasn't a huge supply shock to energy because of that, and food supply to parts of the world, then inflation may have resembled something more transitory. But that's the problem, is you can't bank on these things. Like, you still need to make the right move, and the right move was raising interest rates, regardless.
I,
But so yeah,
I, I think we can say the 9% was somewhat of a outlier getting up to that level. Um, I I would agree with that, and you can even see in the pricing of certain goods and futures that all of that initial, um, and that was all really caused by, unironically, short squeezes, right? Because people having hedges, normal operational things in the market, having to suddenly cover themselves because there's an influx of capital into these markets that typically don't have that. So you can say that's most likely the reason why we had that massive jump in prices, and that's kind of eased out because of the war. But to me, I think that if we didn't have it, inflation would still be elevated, and it would still be problematic for the consumer. And I think it's just showing the Fed that the problem we have is more systemic than they've addressed so far. And I just think that's it. We could coast around 3% for years. Who knows?
that would
Um,
be a decent outcome. I mean, I know it's not the target, but 3%, that'd be a decent outcome.
it would be better than going back up to revisit any of the higher, inflation values.
I agree with that.
A
Yeah.
Yeah, a resurgence up to 4% would be a red flag for me that there's something seriously broken in the economy. And what that is, I don't know. I guess we'll find out.
Well, so many
Um,
moving parts. You can't pinpoint it onto
yeah,
one thing. I reckon
yeah.
that's a good little overview of what's going on in inflation and with the US
Well,
numbers, what's happening with China. Do you want to have any final thoughts before we move on to NVIDIA, PLBY, and SOFI?
I would say an interesting thing to note is that the PPI numbers came out and they were red hot, but inflation expectations went down for the 3 and 5 year, I think. So that was an interesting, reaction to that.
It was an
So
interesting reaction.
my guess is that the expectations went down because if the PPI was hot, the Fed's going to raise rates again. So I think that's what that means, or at least maybe it's a lagging indicator from the expectations, because those are not up to date numbers, if I remember correctly, how they
Yeah,
pull those.
yeah,
So
you're
and
right.
the expectations are always wrong, anyways, right? Because it's what people think is going to happen. So I wouldn't put too much weight into that. It's the Fed who does, and if those change next month and they actually go up drastically higher, then you can see the Fed become more aggressive. So I would tell people who are kind of gaming, which way is the Fed going to go? Are they ever going to do another 75 basis points hike? If expectations become unanchored, which, I mean, by this point, they basically are to me. If they're not 2% in 3 to 5 years, what are they?
True.
If they go hot, if they go significantly higher, maybe, and whatever that number means. then you can expect the Fed to be more aggressive in the terms of the size of the hikes and not just higher for longer and holding higher, but actually aggressively moving rates to higher percentages. So
Yeah,
we could see the return of the 50 basis point. I think that would
hopefully not, but we'll see. I think they probably do have one or two more in them, and then they'll hold for an extended period of time because it's like, as you pointed out to me about a week or two ago, people have expectations. They want a move because they want something to happen overnight. That this is not a game that unfolds in a month or two. This is a sustained effort, 12 months, drain that liquidity. So yeah, there might be one or two more hikes, but I think they definitely want to wait and see for a bit. So
it's encouraging if they can wait and see. It means we've got more time to figure things out than we probably think we do.
I think you've got time. Like from an outsider looking in, I think you do.
Yeah.
So I'm just going to quickly touch on SoFi because we had an interesting mate of ours, Clay. Shout out Clay. Was telling us there was an interesting bit of data going around on Twitter, and I couldn't find any news articles about it. So I checked on. Well, actually, it's called X.com now. X.com, whatever. So a 13F filing for the second quarter of this year showed that Morgan Stanley bought 12.1 million shares of SoFi, which was an 86.4% increase in their position. And then on the 13th of July, they came out and said everyone should sell SoFi because the quote is, "It looks increasingly like a bank. We believe it needs to be valued more like a bank." End quote. So that's. Oh, sorry. They bought 5.6 million shares, which brought their total to 12.1. So that was an 86% increase. But then one thing you and I were sort of just spitballing about just before we started this was the timing looks suspect, but remember that 13F filings are lagging. So it's possible that they bought these extra shares at some point in the second quarter when SoFi was at its lows. And then the 13th of July is... We would not yet have captured what they've done since then. So it's possible that, like, that's the start of the third quarter. It's possible that they might have sold or trimmed that position significantly since SoFi has been on a tear. So even though the timing looks suspect, Wiz and Clay, it might be the fact that they bought and then they sold, a quick trade. What do you reckon, Wiz?
I think that, that's a high confidence buy. To nearly, to 84% increase in your position is, well, maybe for a bank, maybe for them, maybe it's not a lot. To me, it seems like it's a vote of confidence. They may not have sold, but they're definitely not going to recommend people buy it. It may be a sign of maturity for SoFi, which is fine, I think. And the valuation as it is now, it may be a good recommendation, maybe something they're internally muddling over. I guess we'll find out. It's not a bad position for them to have, but I think that adding it to a portfolio now isn't a bad idea, but you have to have expectations that they are kind of like a bank.
I mean, there's some sort of in Australia, we differentiate between banks and other financial institutions, and we might call, like, if SoFi operated here, it might be called something like an Australian deposit taking institution, and they would need a license to take deposits or give loans. Like, so you can be a financial institution but not a full blown bank. But SoFi does look like a bank. Like, they've got mortgages on their book now, so I don't know, man. They're valued at 8.1 billion market cap. At the high in July, they went to $11.45. They're now down to $8.68. They're still not profitable. I think there's like we said last pod, there's potential that they flip to profitability off the back of the moratorium on student loans ending, because that's a huge part of their loan book. It's the majority of it. So yeah.
I think it's not a bad bet, but it definitely is a good point to trim if you were buying it at around $5-6.
Yeah, well, in the second quarter, it got as low as 4.76 in May, So it's
Yeah.
that's potentially when Morgan Stanley was loading up. And then, on the 13th of July, when they said to sell, it was at $9.16. So they might have missed the top, but only just. All
Yeah.
right. So just quickly, mate, do you want to run us through what happened with NVIDIA? And then just after that, I'll wrap up on what happened with Playboy's earnings.
Yeah. So NVIDIA, I think, started the day at around 405 and ended up near 440, which is a massive reversal from the trend we were saying earlier. And does anybody know why that happened? I'm sure if I go look at the tape more closely and check out what happened on options market, we can tell there's a lot of people who probably took profits from NVIDIA dropping down 10% from its high. And then there's people probably speculating that NVIDIA is going to go up until its earnings.
I mean,
So
it's just bonkers to me that, like, people love to buy off these analysts' upgrades. Like, I think Barron's did a piece, and obviously Barron's is massive. Barron's did a piece on them, talking about the AI future and the boom. And it's just like, mate, even if that's true, like, the valuation they have to grow into is enormous.
massive.
So
It's
it is
massive.
enormous. But people are so focused on these short-term analyst estimates. It's actually a really good segue into Playboy, because Playboy had their earnings last week. It was a like, on face value, it was a pretty horrible earnings. But let me unpack a few of the highlights for you, Wiz. So they had a line item called revenue from continuing operations, which was 35.1 million. But their total consolidated revenue included 10 million from discontinued operations. So the revenue was 45.1 million. That's a 31% decline from the total consolidated revenue in the second quarter of 22, where they had 65.4 million. However, since that quarter, they've trimmed like nearly all of their business except Honey Birdette. So they're trying to sell Honey Birdette as well. So and they're also trying to wrap up, some of their media companies. So yeah, that's part of the rationale for why there's a huge drop. Well, obviously it's tough, a tough consumer market, tough sentiment out there right now to sell what Playboy sells, because we were just talking about the rising cost of living and cost pressures. People need to pay for shelter and food. They can't be buying lingerie and sex toys. But that's the go. So yeah, when they if you frame it in the sense that they've sold off some of their businesses, yes, their revenue has declined, but so have their operating expenses. And now this next one's quite a bad looking line item. The net loss from continued operations was 134.3 million. Most of that was driven by cash asset impairments related to write down of goodwill, trademarks, and other assets. So the adjusted EBITDA loss was 1.3 million. And 1.7 of that was attributed to their e-commerce wind down costs. So and the transition to the Chinese joint venture costs. So the one which is driving the licensing business, that part of that was a transition. So I don't know, like, those are sort of the highlight numbers. Overnight, there were downgrades from the analysts that cover Playboy stock. So it's been cut down to US 268 a share, I think was the analyst estimate. So yeah, analysts had been forecasting revenue of US 200 million. But yeah, it's just, I don't know. It's just a bad picture overall. So I've been butchered by my Playboy position, but I'm still, what's the word I'm looking for? I'm bullish on it, but I've got high conviction on this particular stock. I do think that just on the licensing alone, it's going to be worth multiples of what it's currently trading at. And I think that the creator platform is a moonshot. And if that comes off, it'll be off to the races. So yeah, mate, that's the skinny of it. But it's just not a good quarter, and it's just a tough environment for them. And until they can sell off Honey Birdette and clear their debt, or if Honey Birdette can roar back to life with some consumer spending, then that one of those two things needs to happen.
I would definitely say that they may have gotten most of the bad news out this earnings. So as far as surprises go, right? It could just be continuing into the next of the year, seeing how they're going to try to pivot some of those bad numbers, turn them around. But I would say a good move for them would be to open up their centerfold enrollment to more general models. I think would bring more traffic.
Yeah.
That may be what they may need to do.
I was doing a little bit of analysis on this, like looking at the web traffic, and it has been growing. But again, it's that, like you were sort of alluding to, they're a bit selective with who they let on the platform. It's built for, the platform itself is built for a mobile, like kind of looking interface. If you look at it on a desktop, it's absolute garbage. So it's just little things like that they need to address, I think, to make it look polished. But it's moving in the right direction, that one. But it's, again, I'm not hanging my hat on that creator platform. It's more the licensing. But anyway, mate. What were you going to say?
I was just going to say that there's a lot of potential for growth, and we gotta see where that goes. So, but sex sells, though. It always has. It always will.
Mate, I believe in Simponomics. That's my whole PLBY thesis, Simponomics. So it's I don't know, mate.
So yeah,
not financial advice, but I don't. I mean, I'm in it, and I think it's worth throwing a few dollars at. So anyway, mate, that's we're about to wrap up, you and I. So we hate money. If you enjoy what Wiz and I do, please give us a like, comment, subscribe, and hit the bell. And ask us any questions, and we'll endeavor to get a few interesting people on the pod to chat to, because we've got some characters we know, don't we?
Oh yeah, we'll definitely bring some people on that might be more interesting or compelling than we typically are.
Pretty hard because we're awesome.
We're the best, we know. So
we are the best. All right, mate. You take care of yourself.
Thanks, everyone. You too.
See you later, all. Have a good week.